Okay, let's dive in. We've got some really interesting source material today. It's excerpts from a YouTube video looking at two investment options, Nifty Bees and Junior Bees.
That's right. Yeah, the video creator sort of walks through these two ETFs, these exchange-traded funds, and really lays out what makes them tick, what makes them different.
And our job here, really, in this deep dive, is to unpack what the source tells us, highlight the key differences they point out, and, help you get to grips with the factors they suggest matter when choosing between them.
We'll look at how they target different bits of the market, touch on some specific numbers the video throws out there, like, how much money they manage, the fees involved,
Right.
and even how things like, well, your age are presented in the force as potentially influencing the choice.
Yeah, and this is where it gets quite interesting, I think. The source creator actually runs through a scenario showing how, well, what looks like a small difference in past returns could potentially add up over the long haul. Let's get into all that.
Okay, so first things first. The core difference the video really hammers home is what these ETFs actually track. Nifty Bees follows the top 50 companies in the Nifty Index.
The big ones.
Exactly, the established large cap players, your household names, often.
Okay, and Junior Bees. What's the story there according to the source?
So Junior Bees tracks the next set of companies, the ones just below those top 50, based on market size and how easily they're traded. Specifically, it's the Nifty Next 50 Index.
Got it. So 1 to 50 for Nifty Bees, 51 to 100 for Junior Bees, essentially.
Basically, yeah. And this fundamental difference means they offer, different kinds of market exposure. The video suggests Nifty Bees typically offers, let's say, more stable returns.
More stable, like less bumpy.
Kind of. The creator sort of describes it as maybe a more peaceful way, perhaps, less volatile, potentially seeing your money grow steadily over time. That's the angle presented.
Okay. Whereas Junior Bees, tracking those like up-and-coming companies, perhaps.
Yeah. Well, the source presents it as having potential for higher growth, yeah. But the flip side, it emphasizes, is higher volatility, more ups and downs.
Right. So the video implies if you're maybe a bit more aggressive as an investor, you're okay with those market swings, maybe looking for faster growth. Junior Bees might be more your speed.
That seems to be the suggestion from the source, yes. And if you prefer that smoother ride, maybe more modest but steadier returns, then Nifty Bees is positioned as the alternative in this comparison.
Okay, makes sense. Does the video back this up with any, hard numbers?
It does. It brings up a couple of key metrics. First is asset under management, or AUM. That's just the total value of everything the fund holds.
Okay.
For Nifty Bees, the source quotes a pretty hefty AUM, around 38,000 crore rupees.
Wow, okay. That's substantial. And Junior Bees.
Considerably smaller, according to the video. The figure given is around 5,400 crore rupees.
Interesting difference in size. Does the source say why that matters much? Or just states the fact?
It mainly presents it as a descriptive point in the comparison, yeah. Maybe implies something about popularity or history, but doesn't dwell on the implications of the size difference itself too much.
Gotcha. What else?
Another really important one they compare is the expense ratio.
Right.
That small yearly fee they charge for running the fund.
Right. Eats into your returns a bit.
Exactly. And the video states the expense ratio for Nifty Bees is very low, 0.04%.
Okay, tiny. And Junior Bees?
A bit higher, according to the source, around 0.17%.
0.17%. So it's still low in the grand scheme of things, maybe, but definitely higher than Nifty Bees based on this material. And yeah, over time, even small differences there can add up.
Precisely. That's a point often made about expense ratios. Now, probably the most eye-catching part of the source is the look at past performance.
Ah, the historical returns. What did the video find there?
Well, the creator looked at the last 5 years specifically, and they stated that Junior Bees delivered a compound annual growth rate, a CAGR, of about 21%.
21% average annual growth over 5 years.
Okay.
And Nifty Bees?
Over that same period, the source indicates Nifty Bees came in around 19% CAGR.
19%. Okay, so both pretty strong historical figures in that specific period, but Junior Bees edged it out by about 2% per year historically.
Exactly. And this is where the source creator poses that really interesting question. What does that 2% difference actually mean over, say, a couple of decades?
Right. Does it really matter much?
Well, they run a hypothetical calculation, and they're very clear. This is based purely on that past data, and past performance absolutely does not guarantee future results. Everyone needs to remember that.
Crucial disclaimer.
Yeah, but just as an illustration, the video shows if you'd put in, say, 1 lakh rupees, hypothetically, and let it grow at 19% versus 21% for like 20 years, the difference in the final amount becomes quite dramatic.
Ah, the power of compounding kicking in on that extra 2% each year.
Absolutely. It's a potent example, based only on that specific historical scenario they presented, of how even seemingly small percentage point differences annually could lead to a significantly larger outcome over a long investment horizon.
Okay, so pulling all these spreads from the source together, tracking different companies, different stability versus growth profiles, the AUM and expense ratio differences, and this historical performance illustration. How does the video suggest you actually decide?
A really big factor the source emphasizes, well, your personal situation, specifically your age.
Age. How so?
The creator suggests if you're, say, 50 plus, maybe even 45 plus, the lean should perhaps be towards Nifty Bees. It's framed as the more conservative option, like playing for singles in cricket, not always swinging for sixes, is the analogy used.
Right, prioritizing capital preservation a bit more, perhaps, or steadier growth.
That's the implication. But the source continues, if you're younger, maybe in that 30 to 45 bracket, and your style is more aggressive.
You're comfortable with more risk for potentially higher reward.
Yeah, you're okay with that higher volatility we mentioned, aiming for faster growth, perhaps. The source points towards junior Bs as potentially aligning better with that profile.
Interesting framework. But it's just a suggestion from the source, right?
Oh, absolutely.
Yeah.
And throughout the video, the creator makes it really clear, very strongly advises, in fact, that anyone thinking about these should talk to a qualified financial advisor.
Right. This isn't advice, it's just unpacking the source's perspective.
Exactly. Their analysis is presented as their understanding of these ETFs based on the data they looked at, not as a one-size-fits-all recommendation.
Okay. So wrapping up our look at this source material then, the core takeaway seems to be these distinct profiles presented. Nifty Bees tracking the top 50, positioned for stability.
And junior B is tracking the next 50, positioned for potentially higher growth, but also higher volatility.
And the video used those specific data points, AUM around 38,000 crore versus 5,400 crore, expense ratios of 0.04% versus 0.17%.
And those historical 5-year CTRs, 19% for Nifty Bees versus 21% for junior Bs, to kind of illustrate these differences.
But the source emphasizes past performance is just that, past, not a prediction.
Correct. The decision, according to the source, really boils down to matching the ETF's characteristics as presented with your own age, your investment goals, your risk appetite, and ideally doing that with some professional guidance.
So as you, the listener, sort of chew on everything we've unpacked from this specific YouTube analysis, here's maybe a final thought to consider. How does that idea, the one demonstrated by the source's calculation, that a seemingly small annual percentage difference, like that historical 2% CGR gap, could potentially balloon into a really significant outcome over decades? How does that change the way you might look at any investment choice, beyond just the headline return figures?